Good afternoon, ladies and gentlemen. It is June 2nd of 2022, and we're certainly glad that everyone could join us. We're certainly glad to see May come to a conclusion and to start to, build upon some of the recovery that we've seen here over the last couple of weeks. Now, in the email that we send out to clients and advisors, you're going to notice an attachment. Inside that attachment, we encourage everyone to open it up, give it a read. It goes through some latest market thoughts, but then also a review of the weekly trades that we've made in the portfolio, the reasons for the buys, the reasons for the sells, and we certainly encourage everyone to give it a read through. And if you have any questions whatsoever, please feel free to reach out to your advisor, reach out to us, and we can definitely walk you through that. Now, the particular trades that we're publishing this week are just in the growth portfolio. In the ensuing weeks, we will publish all the trades as it relates to the growth portfolio, our blue chip portfolio, as well as the income and preservation strategy. So with no further ado, let's go ahead and get started here. Now, the title of this week's presentation is, Can Stocks Work with Rising Rates? And we know that since the Federal Reserve pivoted on inflation back in November, that it's been a rough go at it for stocks in general, but in particular, growth stocks. And we want to assess, can we make money in this type of environment? So the quick answer to that is yes, it can be tough during that adjustment period, but stocks tend to price news in relatively quick. And believe it or not, a 4 to 5 month period is pretty quick. But once you get past that period, then stocks have absorbed the news and can move independently of the prior news cycle. We call this climbing a wall of worry, or if it's a good news cycle, stocks can often fall in a sea of optimism. So that's the tough part of investing. We can see a news cycle, we can see the headlines, but then stocks kind of move in a way that doesn't make sense relative to the news cycle that we're watching. We think we're entering into one of those periods. So this week, we're going to review some of the short-term trading conditions. What are the risks of a recession? We know that it's out there. We know that it's top of mind for a lot of clients, advisors, and just fellow citizens across the country. And then lastly, what is the current outlook for inflation? So over the next week, there's 3 events we want to watch out for. Number 1 is the employment report that comes out tomorrow on Friday. Depending on when you're watching that, that might be today. Number 2, the consumer and producer price reports that come out next week. So that's your CPI report, that's your PPI report. So basically, we're talking inflation that you notice at the store, that's your CPI report, and then the prices that companies see when they're buying supplies. That's your PPI report. So you got supply chain inflation, consumer inflation. Those 2 come out next week, going to be super critical. We think we'll see a continued deceleration across those 2 categories. And then lastly, quantitative tightening technically began on June 1st, but the actual first bond roll-offs of the Federal Reserve balance sheet will be on June 15th. Lots of fear going into it. We've done this before around 2017 and 2018. The world didn't end. And then lastly, just before we move on, that employment report on Friday, we do want to see the non-farm payrolls be not too hot, not too cold. In other words, we don't want to see a blistering jobs report where the market's going to say, oh my gosh, the Federal Reserve is going to have to raise rates 12 times instead of 10 or 8 times. But we don't want it to be too cold either, where we're like talking about a recession. So kind of a tricky report, but we kind of want it to be right in line with what is forecasted. We also want to see wages keep up with inflation, but not get too hot either. So that's going to be the setup for tomorrow's employment report. Now, in terms of the S&P 500 and the technical backdrop, if you remember from last week in our update, we were rallying. One of the things we noticed, we had this double bottom, which first, if we think about back to mid-May, we put in a low, we rallied, had a head fake rally before testing the lows again, and then heading higher. We said that we were likely going to try and test this resistance point of the prior breakdown. So if you notice here, this was the breakdown going into May. Now we're rallying right up into that resistance line. Now, the good news is that under the surface of the market, growth stocks are beginning to outperform value, and we're starting to see some rising breadth, some consistent rallies day in, day out. So that's something that we like to see here, and we can see that with the growth versus value chart. So this chart basically shows the Russell 1000 growth relative to the Russell 1000 value. For the first time really since March, what we've seen here is a significant breakout of growth stocks versus value. Now, there's one thing that's a little bit different than March. In March, we were still fairly early in the war. We had the Federal Reserve that was still getting incrementally more hawkish versus dovish. In other words, we were still on a path to more and more rate increases that the market had to price in, which ultimately led to this sell-off here. This time around, we're kind of seeing the opposite, where inflation is decelerating, the Fed is getting incrementally less hawkish. So that's a fairly good setup for growth stocks. And quite honestly, the valuations on growth stocks haven't been this attractive since 2017, 2018. If you look at the price to sales ratios of a lot of these stocks, you had this big surge, which was the COVID surge, and now we've reset back to the historical average. So that's happening despite the fact that many of these companies have structurally larger and more profitable businesses. So we really love that setup going forward. Now, in terms of recession, call us crazy here, but during recessions, Google searches for boats and beach vacations and new pools and barbecues and grills. That doesn't happen. These are large discretionary spending decisions that simply don't occur ahead of recessions when your job is in question, when you have a lot of debt, when you're short on cash flow. This is just not the symptom of a recession. Second, the ISM manufacturing report that came out this week actually accelerated versus decelerated and beat expectations. So that measures the level of manufacturing activity in the US. And in addition to that, the leading indicator in terms of new orders accelerated. So again, ISM just doesn't tend to have this type of activity ahead of recessions. To wrap things up, job openings remain near a record high. Now, I know if you are a Federal Reserve watcher, you probably don't want to see that, but quite frankly, I think a good economy should have lots of job openings, should have low unemployment, and jobless claims remain near 50-year lows. There's just not a lot here to suggest that we're going into a recession. Is the economy slowing? Yes, it is. Why? It was running too hot, right? So if we think of potential growth in the US, it's usually in that 2 to 3% range. When you get to 6 or 7, you are basically boiling water off the top, and that's called your inflation. And right now, we're just coming back down to our historical mean in terms of the overall economic growth rate. Now, as it relates to inflation, as it relates to commodities, for the first time, we are starting to see some demand destruction as it relates to oil, and in particular, gasoline. So we can see here, gasoline is now down. Gasoline consumption is now down year over year, and that's at the seasonal peak of gas consumption, right? So when we think of Memorial Day weekend, that's your seasonal peak for the most part as it relates to gasoline consumption. So we've gone negative year over year on the strongest point of the year. I think that's good news. The other thing that we've started to see is that OPEC is starting to open the taps for further oil supply. In addition, believe it or not, yes, despite some of what you hear in the press, oil companies here in the US are starting to activate more rigs, more wells are being activated, and you are starting to see that production come along. We wish it was a little bit faster, but it is coming along. And then as it relates to commodities, X oil, I know again that we hear a lot about the press in terms of the war and food shortages and all these other types of things. Lumber is in a downright bear market. Copper has broken its uptrend. I mean, it's down over 4%. Platinum's down 17%. Lumber down 50%. Iron ore down 26%. Rubber down 3%. Pulp is relatively flat. If we go over to the food items, corn is off 10.1% from its high. Wheat is down 17% from its May high. And it's actually down 25% from its March panic high. So across the board, commodities are selling off. The one commodity that really hasn't come off that much is oil. And when the breadth of commodities starts to break down, at some point, gravity does have an impact on the last soldier standing, which is oil. And so we do think that at some point, oil will follow the rest of the group lower. So what does that mean for interest rates, interest rate expectations, and how does that relate to stocks and the types of stocks that we buy? If we look at what the market is pricing in terms of inflation expectations, we can see here over 12 months, over the next 12 months, the market has gone from about 6.3% expected rate of inflation all the way down to 4.8%. And you're starting to see that impact on how many rate hikes are expected by year end of 2022. We've gone from about 10 rate hikes that were expected throughout the course of 2022 all the way down to about 7.5. 50 basis points in June and July, that's in the bag. After that, it becomes a question of 50 or 25. And then as we get into the fall, whether or not we even have any more rate hikes. There's slow signals here that if inflation does indeed have a steep drop, that the Federal Reserve may actually hit pause on further rate increases going into the fall. That's a big if. I still think we're going to get these 25 basis point hikes until we get clear signs that inflation's breaking down. But remember, the market's pricing in a very aggressive Fed. So if the Fed comes in a little bit less aggressive, that's good for stocks. And in particular, we believe it's good for growth stocks versus value, because growth stocks are where no one is right now. And that's where the valuations are, in our opinion, the most attractive. And that would be the painful trade going into the back half of the year. Everyone is now positioned into value. No one's really positioned into growth. The pain trade would be growth over value, and the stocks go up while bond prices also go up. So that's kind of like the setup we actually think could potentially unfold here over the next 6 months. So bottom line, we do see a lot of evidence here building that growth, and actually Chinese stocks are trying to bottom as valuations hit those multi-year lows. Commodities are quietly selling off. We want to pay attention to that. It's something the Federal Reserve is paying attention to, therefore we must. We do think stocks are trying to carve out a bottom. We would like to see a break above sort of those prior breakdowns to increase our level of confidence, and then get above those moving average resistance points. And then lastly, we do think interest rate expectations are beginning to fall as growth and inflation slow. Thank you again. I know it's a bit of a shortened week this week, but I do encourage everyone to go into our attachment, into our note, to look at the trades that we've done, why we did them. And then in particular, also feel free to follow us on Twitter, where we do offer daily updates on the market. Have a great weekend, everyone. And again, if you have any questions, please feel free to reach out to your advisor or our offices. Thanks again, and have a great weekend.